Welcome to the final section of this series. We have built the full P2P framework, the process, the controls, the accounting, the risks. Now we apply it. How do you actually use this knowledge with a client? How do you adapt it to different business types? What do you do when you walk in and find the most common real-world problems? And how do you measure whether the cycle is healthy? This session answers all of those questions. By the end of this session, you will be able to use a structured 5-step method to assess any client's P2P cycle from scratch. You will know how the cycle looks different and what risks are different across product businesses, service businesses, and project-based businesses. You will be able to respond to the 4 most common real-world P2P problems with specific, practical advisory actions. And you will be able to interpret the key performance indicators that tell you whether a client's P2P cycle is actually healthy. Every advisory engagement on P2P starts the same way, with understanding. Not the controls, not the risks, not the KPIs. The first question is, how does this client actually buy things? Do they purchase physical goods, professional services, or a combination? Is there a central procurement team that manages all purchasing, or do individual departments buy independently? Do they have a formal approved vendor list, or do they buy from whoever is available? How large are their typical purchases, and how frequent? These answers determine what level of control complexity is appropriate. A small service business buying primarily from 3 known suppliers needs a different control environment than a manufacturer sourcing from 200 vendors globally. Once you understand how the client buys, you map their actual flow against the 11 stages, not the process they describe in their policy document, the process that actually happens. Walk through every stage and ask, does this approval exist? Does it actually happen? Who does it? Are the vendors, invoices, and payments approved by genuinely different people? The gap between the documented process and the actual process is where the real advisory work lies. Clients often have a procurement policy that says the right things, but in practice, approvals are skipped, the PO is raised after the invoice arrives, and one person handles everything from vendor setup to payment. The third step is a targeted fraud and error risk assessment. In P2P, this is not a generic internal controls review. It needs specific questions about the highest risk failure points. Can one person add a vendor and authorize payment to that vendor? If yes, fictitious vendor fraud is possible. Are duplicate checks run before every payment run? If not, duplicates are happening and are not being caught. Is the 3-way match enforced, or are overrides routine? Routine overrides mean the match is not functioning as a control. And when a vendor requests a bank account change, is it verified by calling the supplier on a known number, or is the change applied based on the email? These 4 questions cover the majority of high-impact fraud risk in P2P. Step 4 is where advisors often underdeliver. Telling a client to strengthen AP controls is not advice. It is a placeholder. Recommendations must be specific and actionable. Not improve the 3-way match process, but implement a system-enforced 3-way match that cannot be overridden without dual authorization and a documented exception log. Not improve vendor master controls, but require dual authorization and phone verification for every vendor bank account change, with a monthly audit of all changes made. Step 5 sets up the reporting that allows the client to monitor their own AP health without depending on your team. AP aging reviewed weekly, DPO tracked monthly, Maverick spend reported to management. A client who can see their own cycle health is a client you have genuinely served. The 11 stages are universal, but the emphasis and the key risks shift by business type. In a product or manufacturing business, retail, wholesale, or FMCG, purchasing is high volume and GRN discipline is critical. Every inventory receipt must be documented promptly, or the 3-way match breaks down and the GRNI balance becomes a problem. In a service or professional business, there is no physical delivery. Milestone sign-offs or service confirmations replace the GRN. The risk is different. Services billed but not confirmed as complete, or software subscriptions renewed without review. In a project-based business, construction, engineering, development, and payments are tied to project milestones that must be independently verified. The risk is paying for a milestone the project team has not formally confirmed as complete. 4 real-world scenarios come up repeatedly in P2P advisory work. The first two are duplicates and maverick spend. When a duplicate invoice is received, same vendor, same amount, same date or invoice number, the correct response is: run the duplicate check, hold the second payment, contact the supplier for a credit note, and log the exception. Then strengthen invoice registration to flag duplicates on entry, not on payment. When an invoice arrives with no PO maverick spend, the response is not to pay and move on. Require a retrospective PO with management approval, log the instance, track it monthly, and go back to the department to address why they bypass procurement. The root cause is usually speed. Departments bypass the process to move faster. The risk they are creating is worth explaining directly. The third scenario is a vendor bank account change request received by email. This is one of the most common fraud vectors in P2P, and the advisory response must be unambiguous. Never change vendor bank details based on email alone, regardless of how legitimate the email looks. Call the supplier on an independently verified number. Get dual authorization. Log the change with full documentation. The fourth scenario is goods received at period end with no invoice yet arrived. This is an accounting accuracy issue that requires an accrual, debit expense, credit accrued liability. The accrual is reversed at the start of the next period when the invoice arrives. If this is not done, profit is overstated for the period, and the next period's invoice creates a double hit to expenses. The KPIs you set up for a client should connect directly to the risks and controls you have assessed. Days payable outstanding tells you how long the business takes to pay and whether that is a deliberate cash management decision or a backlog. AP aging shows where invoices are accumulating and whether the cycle is moving or getting stuck. On-time payment rate measures whether supplier relationships are being respected. The three-way match exception rate shows whether invoices are arriving in good order or whether there is a systemic mismatch between POs, GRNs, and invoices. And PO coverage rate is the headline measure of procurement discipline. What percentage of spend actually went through the proper process? Together, these 5 tell you most of what you need to know about the health of a client's P2P cycle. The Procure-to-Pay advisory method starts with understanding, moves to mapping the actual flow, identifies specific fraud and error exposure, recommends precise actionable controls, and sets up the reporting that gives the client visibility going forward. It adapts to the business model, product, service, or project, because the same stages carry different risks in different contexts. Real-world scenarios require real-world responses, specific, documented, and aimed at the root cause. And the KPIs are the ongoing health check, the dashboard that tells you whether the controls you recommended are working. This completes the Procure-to-Pay series. Thank you for completing this session and for completing the full Cycle 2 training.